Are your investments working as hard as you are? In today's economy, every penny counts. You work hard for your money, your investments should work just as hard for you. That's why we're diving into the world of ETFs and exploring a popular choice, SCHD. Investing isn't just about putting money aside, it's about making your money work for you. The right investments can grow your wealth and secure your financial future. So let's ensure your investments are as diligent as you are. Stay tuned as we break down the SCHD ETF and how it can work for you.
SCHD, a dividend ETF that's making waves. SCHD stands for Schwab U.S. Dividend Equity ETF. It's an exchange-traded fund focused on U.S. companies with a history of paying dividends. Launched in 2011, SCHD has consistently performed well, offering a solid dividend yield. Over the years, it has attracted a significant following due to its reliable returns. Recently, SCHD underwent a reconstitution, meaning its holdings changed. This shakeup has investors talking. Should you be worried? Let's find out.
ETFs, a beginner's guide to investing made easy. Before we go further, let's talk ETFs. Think of an ETF like a basket of stocks. When you buy an ETF, you're investing in all the companies in that basket. ETFs are a great your portfolio without buying dozens of individual stocks. There are different types of ETFs, such as index ETFs, sector ETFs, and bond ETFs. Index ETFs track a specific index like the sector ETFs focus on specific industries like technology or healthcare. Bond ETFs invest in a variety of bonds, providing income and stability. Understanding these types can help you choose the right ETF for your investment.
SCHD's winning formula: consistent growth and dividends. SCHD has built a solid reputation. It's known for investing in companies with a history of paying dividends. Dividends are like bonuses paid to shareholders. SCHD focuses on companies with strong financial health, increasing the likelihood of consistent dividend payments. For example, Coca-Cola, a staple in SCHD, has a long history of paying dividends. Similarly, PepsiCo is another company in SCHD known for its reliable dividend payments. Home Depot, also part of SCHD, consistently rewards its shareholders with dividends. These companies exemplify the benefits of consistent growth and dividends, making SCHD a reliable choice for investors.
Outperforming the market: SCHD versus the giants. SCHD has consistently outperformed the S&P 500, a popular benchmark for the US stock market. This means that historically, SCHD has delivered better returns than simply investing in the broader market. Past performance doesn't guarantee future results, but it's a good sign. When compared to other major ETFs like VOO and QQQ, SCHD has shown competitive performance, often leading in dividend yield and stability. Over the past decade, SCHD has delivered an average annual return of around 13%, outpacing many of its peers. While no investment is without risk, SCHD's track record makes it a compelling option for those seeking both growth and income.
The SCHD shakeup. What's changed and why? Now, about that reconstitution. Every year, SCHD adjusts its holdings based on its investment strategy. This ensures it continues to meet its objectives. Some companies get added, some get removed. It's like spring cleaning for your portfolio.
Out with the old, in with the new, analyzing the shifts. Let's look at the companies that were removed and added. This can give us clues about SCHD's future direction. Are they focusing on different sectors? Are they betting on new trends? We'll analyze the changes and see what they mean for investors. For example, companies like XYZ Corp and ABC Inc. were added, while Def Limited and GHI Co. were removed. The new additions indicate a shift towards technology and healthcare sectors. Historical performance and future projections suggest a strategic move to capitalize on emerging trends. This strategic shift could mean significant opportunities for investors.
Sector Spotlight, where SCHD is placing its bets. The reconstitution also shifted SCHD's sector allocation. Sectors are categories like technology, healthcare, or energy. By looking at the sector changes, we can see where SCHD sees the most potential for growth and dividend payments. The technology sector has seen a significant increase in allocation, indicating SCHD's confidence in its growth potential. Meanwhile, the healthcare sector remains a stable choice for dividends. Energy sector allocations have been adjusted to balance risk and reward. These changes reflect SCHD's strategic approach to maximizing returns.
The long view. What this means for your portfolio. Change can be unsettling, but it's important to remember that investing is a long-term game. Different types of portfolios will be affected in various ways. SCHD's reconstitution is designed to keep the ETF strong for the future. Don't panic. For growth-focused portfolios, this could mean new opportunities. Instead, focus on your financial goals and make sure your investments align with them. Income-focused portfolios might see changes in dividend yields. Diversified portfolios can benefit from the rebalancing, ensuring a balanced risk-reward ratio. Stay informed and consult with your financial advisor.
The bottom line, is SCHD right for you? So, is SCHD right for you? The answer depends on your individual circumstances, risk tolerance, and financial goals. Do your research, consult a financial advisor, and make informed decisions. Remember, investing is about building a secure future, one smart decision at a time. What are your thoughts on SCHD's reconstitution? Let's discuss in the comments below. Here are some tips to decide if SCHD is right for you. Consider your long-term goals, risk tolerance, and consult with a financial expert. Make sure to stay informed and make decisions that align with your financial future.
In this chapter, we'll discuss the future outlook of SCHD, including potential growth areas and risks. As we move forward, SCHD's focus on high-quality dividend-paying companies remains a cornerstone of its strategy. One key area to watch is the evolving landscape of dividend policies among major corporations. With market conditions constantly changing, SCHD aims to adapt and optimize its portfolio to maintain consistent returns. Experts in the field have mixed opinions. Some are optimistic about SCHD's ability to weather economic downturns due to its diversified holdings, while others caution about potential volatility in the dividend space. Market trends indicate a growing interest in dividend ETFs, which could drive more investment into SCHD, potentially boosting its performance. However, it's essential to be aware of the risks. Economic uncertainties, regulatory changes, and shifts in corporate profitability can all impact SCHD's returns. As an investor, staying informed and understanding these dynamics is crucial. Overall, SCHD's future looks promising, but like any investment, it comes with its own set of challenges. Keep an eye on market trends, expert analyses, and SCHD's strategic moves to make the best decisions for your portfolio. What do you think about SCHD's future? Share your thoughts in the comments below. And as always, make informed choices to build a secure financial future. While SCHD is a popular choice, there are other ETFs that might suit your investment strategy. In this chapter, we'll explore some alternative ETFs, their benefits, and how they compare to SCHD. First on our list is VIG, the Vanguard Dividend Appreciation ETF. VG focuses on companies with a history of increasing dividends, offering a different approach to dividend investing compared to SCHD. Its emphasis on dividend growth can be appealing for those looking for long-term appreciation. Next, we have SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF. SPHD targets high-yield, low-volatility stocks, aiming to provide steady income with reduced risk. This ETF is an excellent option for those seeking stability in their investments. Another noteworthy option is DGRO, the iShares Core Dividend Growth ETF. DGRO combines dividend growth with a diversified portfolio, providing a balanced approach that appeals to a broad range of investors. Lastly, let's consider HDV, the iShares Core High Dividend ETF. HDV focuses on high dividend-paying stocks from various sectors, offering a robust income stream for income-focused investors. Each of these ETFs has its unique strengths, and depending on your investment goals, they might offer advantages over SCHD. Diversifying your portfolio with a mix of these ETFs can help balance risk and reward, ensuring a more resilient investment strategy. Take the time to research and understand these alternatives to make informed decisions that align with your financial goals. Which ETF do you prefer? Let us know in the comments below, and don't forget to like and subscribe for more investment insights. Investing in ETFs can be a great way to diversify your portfolio, but there are common mistakes that investors should avoid. In this chapter, we'll discuss these mistakes and how to avoid them. First, don't overlook the importance of fees. While ETFs generally have lower fees compared to mutual funds, they can still add up over time and eat into your returns. Always check the expense ratios and understand what you're paying for. Next, avoid chasing past performance. Just because an ETF has performed well in the past doesn't guarantee future success. Make sure to do your own research and understand the underlying assets and strategy of the ETF. Another common mistake is not considering the tax implications. Some ETFs can be more tax efficient than others, so it's essential to understand how capital gains and dividends will affect your tax situation. Diversification is key, but over-diversifying can also be a problem. Holding too many ETFs can lead to redundant holdings and dilute your potential gains. Aim for a balanced portfolio that aligns with your investment goals without overcomplicating it. Lastly, don't forget to review your investments regularly. The market and your financial situation can change over time, so it's important to reassess your portfolio periodically to ensure it still meets your needs. By avoiding these common mistakes, you can make more informed decisions and set yourself up for long-term success in your ETF investments. Remember, investing is a journey, not a race. Take your time, do your research, and stay informed. Which mistake do you think is the most common? Share your thoughts in the comments below and don't forget to like and subscribe for more investment insights. Market conditions can significantly impact the performance of ETFs. In this chapter, we'll discuss how different market conditions affect ETFs and what investors should keep in mind. First, let's talk about bull markets. During a bull market, most ETFs tend to perform well, especially those focused on growth stocks and sectors like technology and consumer discretionary. Investors often see higher returns during these periods, but it's crucial to remain cautious and not get swept up in the euphoria. Over-investing in a hot market can lead to significant losses when the market corrects. On the other hand, bear markets present a different set of challenges. ETFs that focus on defensive sectors such as utilities, healthcare, and consumer staples often fare better during downturns. Additionally, some ETFs are designed to provide a hedge against market declines, such as inverse ETFs. However, these can be complex and risky, so it's essential to understand how they work before investing. Market volatility also plays a key role in ETF performance. High volatility can lead to rapid price changes, creating opportunities for short-term traders, but increasing risk for long-term investors. ETFs with higher liquidity tend to handle volatility better, while those with lower liquidity can experience larger price swings. Interest rates are another critical factor. When interest rates rise, bond ETFs typically suffer as bond prices fall. Conversely, when rates drop, bond ETFs tend to perform better. Equity ETFs can also be affected by interest rates, particularly those in interest-sensitive sectors like real estate and financials. Finally, global events such as geopolitical tensions, economic policies, and pandemics can have widespread effects on ETFs. Diversifying across different regions and sectors can help mitigate some of these risks, but it's essential to stay informed about global developments and adjust your portfolio accordingly. In conclusion, understanding the impact of market conditions on ETFs can help you make more informed investment decisions. Keep these factors in mind, stay diversified, and always do your research. How have market conditions affected your ETF investments? Share your experiences in the comments below, and don't forget to like and subscribe for more insights into smart investing. Diversification is key to a successful investment strategy. In this chapter, we'll discuss the role of ETFs in a diversified portfolio and how they can help manage risk. ETFs, or exchange-traded funds, offer investors a way to spread their investments across a wide range of assets, sectors, and regions. This diversification can help mitigate the risks associated with investing in individual stocks or bonds. For instance, if one sector underperforms, the gains in another sector can help balance out the overall performance of your portfolio. One of the primary benefits of ETFs is their ability to provide exposure to a broad market index or a specific sector with just one investment. This makes it easier for investors to build a diversified portfolio without needing to buy and manage multiple individual securities. For example, an ETF that tracks the S&P 500 gives you exposure to 500 of the largest companies in the U.S., offering diversification across various industries. ETFs also allow for international diversification. By investing in ETFs that track foreign markets, you can gain exposure to global economic growth and reduce the risk associated with being too heavily invested in one country's economy. This can be particularly useful in times of economic uncertainty when different regions may perform differently. Another advantage of ETFs is their cost effectiveness. ETFs generally have lower expense ratios compared to mutual funds, making them a more affordable option for building a diversified portfolio. Additionally, because ETFs are traded on exchanges like stocks, they offer flexibility and liquidity, allowing you to buy and sell them throughout the trading day. It's also important to consider the role of bond ETFs in a diversified portfolio. Bond ETFs can provide stability and income, especially during times of stock market volatility. By including both equity and bond ETFs in your portfolio, you can create a balanced mix that aligns with your risk tolerance and investment goals. In conclusion, ETFs play a crucial role in a diversified portfolio by offering broad market exposure, international diversification, cost effectiveness, and flexibility. By incorporating ETFs into your investment strategy, you can manage risk more effectively and work towards achieving your long-term financial goals. How do you incorporate ETFs into your diversified portfolio? Share your strategies in the comments below, and remember to like and subscribe for more investment insights. Understanding the tax implications of investing in ETFs is crucial for maximizing returns. In this chapter, we'll discuss the tax benefits and considerations of investing in ETFs. One of the primary tax advantages of ETFs is their tax efficiency. Unlike mutual funds, ETFs typically generate fewer capital gains distributions. This is due to the unique structure of ETFs, which allows for in-kind creation and redemption processes. These processes help minimize the need to sell securities within the fund, thus reducing the likelihood of taxable events. Another tax benefit of ETFs is the potential for lower capital gains taxes. When you sell an ETF, you may be subject to capital gains tax based on the difference between the purchase price and the sale price. However, if you hold the ETF for more than a year, you may qualify for the lower long-term capital gains tax rate, which can be significantly less than the short-term rate. It's also important to consider the tax treatment of dividends from ETFs. Qualified dividends are typically taxed at a lower rate than ordinary income. Many ETFs invest in dividend-paying stocks, and the dividends received by investors may qualify for this favorable tax treatment. However, it's essential to understand the specific tax rules that apply to the dividends from your ETFs. Investors should also be aware of the potential impact of foreign taxes on international ETFs. Some countries withhold taxes on dividends and interest paid to foreign investors. While you may be able to claim a foreign tax credit on your U.S. tax return, it's important to understand how these taxes can affect your overall returns. Another consideration is the tax implications of ETF distributions. Some ETFs distribute income to investors in the form of interest, dividends, or capital gains. These distributions are generally taxable in the year they are received, even if you reinvest them. It's important to keep track of these distributions and report them accurately on your tax return. Lastly, it's essential to consider the impact of tax loss harvesting on your ETF investments. Tax loss harvesting involves selling investments that have declined in value to offset gains from other investments. ETFs can be an effective tool for tax loss harvesting because they offer a wide range of investment options and can be easily traded. In conclusion, understanding the tax implications of investing in ETFs can help you maximize your after-tax returns. By taking advantage of the tax efficiency of ETFs, understanding the tax treatment of dividends and distributions, and utilizing tax loss harvesting strategies, you can enhance your overall investment strategy. Remember to consult with a tax professional to ensure you are making the most informed decisions for your unique financial situation. How do you manage the tax implications of your ETF investments? Share your strategies in the comments below, and don't forget to like and subscribe for more investment insights. The ETF market is constantly evolving. In this chapter, we'll discuss the future of ETFs, including emerging trends, new types of ETFs, and what investors can expect in the coming years. First, let's look at some of the emerging trends. One major trend is the rise of thematic ETFs. These funds focus on specific themes or sectors such as technology, clean energy, or healthcare innovation. As investors become more interested in aligning their investments with their personal values and interests, thematic ETFs are expected to grow in popularity. Another trend is the increasing demand for ESG, environmental, social, and governance ETFs. These funds aim to invest in companies that meet certain ethical standards. With growing awareness of social and environmental issues, ESG ETFs are likely to see significant inflows in the future. Next, we have actively managed ETFs. Traditionally, ETFs have been passively managed, tracking an index. However, actively managed ETFs, where fund managers make decisions about the portfolio, are gaining traction. These funds offer the potential for higher returns, albeit with higher risks. We're also seeing innovation in the types of ETFs available. For example, non-transparent ETFs, which don't disclose their holdings on a daily basis, are a recent development. These funds aim to protect the investment strategies of active managers while providing the benefits of an ETF structure. Moreover, leveraged and inverse ETFs, which aim to deliver multiples of the performance of an index or the inverse of an index, are becoming more sophisticated. These ETFs can be useful for short-term trading strategies, but come with higher risks. Looking ahead, technology will play a crucial role in the ETF market. Advances in artificial intelligence and machine learning are likely to lead to the creation of more sophisticated and efficient ETFs. Additionally, blockchain technology could revolutionize the way ETFs are traded and settled, making the process faster and more transparent. Regulatory changes will also impact the future of ETFs. As the market grows, regulators are likely to introduce new rules to ensure investor protection and market stability. Staying informed about these changes will be crucial for ETF investors. In conclusion, the future of ETFs is bright and full of opportunities. From thematic and ESG ETFs to actively managed and innovative new types of funds, investors have a wide range of options to choose from. As the market continues to evolve, staying informed and adaptable will be key to making the most of these opportunities. What trends are you most excited about in the ETF market? Share your thoughts in the comments below, and don't forget to like and subscribe for more updates on the world of investing.